Hi, I'm Jason Hawkins, founder and president at Lightpath Wealth Advisors. And today I'd like to share with you a recent case study that I worked on with a client to help drive home the potential value of owning life insurance on your kids. I want you to meet John. He has two children. His daughter Mallory is 9 years old and his son Bryce is 3 years old. He was disappointed with himself that he hadn't started saving sooner for Mallory. It was his intention to get something started when Mallory was more like Bryce's age. John would like to start saving approximately $1,200 per month in total for both Mallory and Bryce, but he wants to make greater contributions for Mallory because he has some catching up to do. John's plan is to fund both Mallory and Bryce's program until they reach the age of 18. John's not exactly sure what the money will be used for in the future, but he wants flexibility to use it for whatever he deems necessary. Meaning he could use it to pay for college expenses, to cover family emergencies, to supplement his own retirement, or it may just end up being a contract that he eventually transfers ownership over to both Mallory and Bryce, once they're old enough to understand and appreciate what he has done for them. At that point, Mallory and Bryce could use the money for immediate financial needs, or they can let it continue to grow and accumulate for the future. The product that I ultimately ended up recommending for John in this scenario was an indexed universal life insurance contract. It checked all the boxes for John. It's a safe and secure savings vehicle, it's tax efficient, and it offers a ton of flexibility in the future. And should he ultimately end up transferring ownership to both Mallory and Bryce, it would serve as a great foundational piece for them. To further drive home the value of the contracts that John is setting up for both Mallory and Bryce, we're going to focus on Mallory's policy and walk through how this could potentially play out for both John and Mallory, but also for those grandchildren that aren't yet in the picture. So for Mallory's policy, if you recall, we're working with a $1,200 per month budget, of which John would contribute $690 per month towards Mallory's policy, with the remaining balance being allocated towards Bryce's contract. In the end, the total contributions would work out to be about the same. At age 18, John would have effectively saved $91,080 into Mallory's contract. The projected account value when Mallory is 18 after credited interest and deducted expenses is around $103,000. At this point, if he needed some money for college, he would have a nice bucket of cash to pull from, but let's say that Mallory ended up not going to college or was fortunate enough to get a scholarship to cover her college expenses. At this point, John is still the owner of the contract and ultimately in control of these assets. John is still working and doesn't have a need for the money either, so he cuts off the contributions at age 18 like originally planned, and the money continues to grow and accumulate over the next several years. Now, let's turn the clock forward some. Now that Mallory is 40 years old and has a family of her own, thankfully she's self-sufficient because John taught her how to effectively save and budget on her own. But let's say even at age 40, neither John or Mallory have a need for this money. At this point, John is 70 years old and already living in retirement. The bucket of money has grown to $495,000. John is still the owner of the contract and ultimately in control, but John's not sure how much longer he'll be around, and Mallory has clearly displayed her ability to effectively manage her own household finances, and John now wants to transfer ownership of this contract over to Mallory. This is the point where Mallory would gain control of these assets and ultimately determine how the money gets used. Now, since Mallory is a saver and would prefer that this money continue to grow and accumulate, she decides to hold off accessing this money and plans on using the money as her primary source of retirement income when she retires at age 65. At 65, that $91,080 in contributions that John made many years ago has grown to become $2.9 million in available assets, and Mallory could start taking annual tax-free distributions in the amount of $275,000 per year, all the way to age 100. But let's assume that Mallory doesn't live to be 100, but instead passes away at age 85. At that point, Mallory would have received over $5 million in living benefits during that 20-year period that she was taking distributions from her policy. And on top of that, she still has a death benefit of $1.5 million that is going to be passed on tax-free to her beneficiaries, which just so happens to be John's grandchildren. At this point, you know that both John and Mallory are looking down from heaven with a huge smile on their face, as collectively they've taken every dollar of contribution and turned it into more than $6 million in total benefits. That's like taking every dollar of contribution that John made and turning it into more than $70 in tax-free benefits. Wow. Now, if that's not a financial legacy that you can get excited about starting for your family, I'm not sure I can help. But on the other hand, if you'd like to explore starting your own financial legacy, Lightpath Wealth Advisors would love to discuss your options with you. Until next time, this is Jason Hawkins with Lightpath Wealth Advisors, where we help you navigate the retirement journey together.